Hi, my name is Yasha and I help young men invest in the stock market so that they can actually make some money. Now today we are going to analyze this extremely famous American bank called Citigroup Incorporated with the stock ticker C. Now as always we are going to analyze it using this little Canva presentation that I have right now here. So let's begin, okay? First, why should you even listen to me? My name is Yasha and as you know I help young men invest in the stock market so that they can make some money. So if you are interested in that, click the first link in the description. Now let's begin with the actual analysis. I know that when you are a beginner you might seem that, stock market might seem a bit complicated, so I will guide you here very beginner friendly through all of the steps that you need to do. I will show you little tips and tricks how to analyze stocks. It's nothing too big to think about it, don't overthink it. Grab a piece of paper, grab a pen and let's begin, okay? Now, as a complete beginner, you should generally care about the following things when you analyze the stock, okay? You should care about chart, profit, debt, money on the bank account, value and price. Now here you have some quick facts about Citibank. So it's a bank, obviously, and it was founded in 1812, I don't know how to pronounce that correctly, and it is the third biggest bank in the US. Now here I want to have your attention because whenever the company is founded is extremely important for us, okay? So Citibank was founded in 1812, I don't know if I said that correctly, but in this year. Now you should generally invest in the stocks that or at least in the companies that are a bit older, preferably at least from 1960, and backwards. Because if you invest in stocks that are a bit young, for example, if you have some startup that was founded maybe 2 years ago, you don't know for sure if that startup will survive any major crisis, okay? Whereas this bank, for example, Citibank was founded almost 200 years ago, so you for sure know that it survived a few major crises, okay? For example, the Big Depression, or how was that called? Then the Black Monday, the 2000 that dot-com bubble, it survived 2008 real estate crash, it survived Corona crisis, you know what I mean? So there are like a few, let's say 5 major events where the stock market crashed and this bank is still here, it survived. So that's the point, okay? The point is to invest in companies that are a bit older because therefore you know that the management is good, that the company has higher chances of survival if something unexpected happens, okay? So that's the first tip. And now we come to the actual analysis and we will begin with the chart, okay? And for chart we have a little instruction here that tells us chart has to grow for all 10 years. Now what exactly does that mean? That means that I will draw a little exponential growing line, kinda like this, and we are going to compare the actual stock price chart, which is the orange line, with this black line on the screen, okay? And preferably they should follow each other because that's important, because we want to invest in companies that are growing, that have growing prices, that are profitable, because obviously that's a good investment, that's a good deal, and that will make us money. It's that simple, like use your brain, bro, you are not stupid, okay? So let's take a look at the chart here. You can see that the chart does not follow that exponential line. Now, keep in mind, this is a bank, okay? Generally, the companies should grow through the years, it should follow, the stock price line should follow that exponential line. But in this case, banks always go up and down, up and down, up and down. They are kind of steady, because if you are a bank, how can you actually escalate the business? How can you accelerate the profitability and so on? It's very hard, to do that as a bank, because as a bank you usually have loans, you have maybe some real estate investments, and then that's about it, Basically banks just make business with loans. It's that simple. So for banks, it's usually okay to have that a bit chart that it goes up and down, but still it should be at least with that upward trend, okay? Now here we don't have growing chart because the rule tells us here it has to grow for all 10 years. So we will mark chart as a no-go as well, okay? Because whenever we analyze stocks, we want to be as harsh as possible whenever we analyze them, okay? Now let's come to the profit. And for profit, we have an instruction that tells us profit has to be in plus and it has to grow through the years as well, okay? Now, here is the same story as with the stock price chart. We will draw a little exponential line, kind of like that. And now we are going to compare the profit with this line. Now, you can see here we have two different expressions. We have profit and net income. This is exactly the same thing, okay? So let's take a look now. The chart generally does not follow that exponentially growth line, you know, but here is another thing. In 2017, the Citigroup had a loss, and that's immediately a no-go. Whenever you see a company that had loss in the last 10 years that you analyze, that's immediately a no-go. Don't even think about the stock chart anymore. I mean, don't think about the profit chart anymore, because whenever you have a loss, it's a no fucking go, okay? No go. We don't want that. We don't want companies that have loss. We don't want that at all, okay? We want growing, profitable businesses, okay? So here immediately no go without even thinking, okay? Now we come to the debt, and for debt we also have an instruction that tells us debt has to be low, and preferably, bro, it should decrease through the years, okay? Now what do we have here? Here we have kind of growing debt, as you can see, so we have exactly the opposite. Oops, so that's a bit bad line. Wait, let me correct it. Sorry about that, bro. The line goes kind of like that. It grows, which means the debt is also growing, okay? So here, same thing, the debt does not decrease, and it's a no-go, okay? Debt, no thank you. Now we come to the money, and with that money that we analyze right now here, we actually take a look at the money that they have on their literal bank account, okay? For example, on your bank account right now, you might have around 300 euros or $300, and here we are analyzing the very same money that is on their bank account, okay? And preferably, they should have more money than costs. Because why is that important? When they have positive bank account, they can cover some unexpected events, okay? For example, all of those crises that I told you about. So the Great Depression, the dot-com bubble, the Black Friday, stock market crash, I mean in 2008, Corona crisis, and all of those unexpected events. If they have money, they can cover them. Same as you. If you are broke, you cannot cover anything unexpected, you know? But if you are rich, you can still breathe a bit easier because you have the money to cover certain costs, okay? And here it's exactly the same. Now let's take a look. Do they have more money than the costs? Obviously not. Why? Because take a look at here now. Wait, my mouse doesn't work. Now let's take a look at here. They have minus $12 billion on their bank account. This is absolutely horrible because you want to have positive bank account. Now, if something unexpected happens, they will have to take a loan again to cover that unexpected event, which will increase the debt right now here, which will just furthermore like make a loop, you know. So that's a no-go as well. Money is in minus. We don't want that at all. Nobody wants a broke person, you know. Even the girls, that's why they don't have sex with you, because you are broke. It's that simple, you know. Now let's come to the valuation. And obviously, when we invest in the stock market, we want to invest in stocks that are undervalued, okay? Look at here. Now, how do we measure valuation? We measure it by two little things. We measure it by so-called P/E ratio and by intrinsic value. Now, as a rule of thumb, I know that you are a beginner, so this might sound a bit complicated, but P/E ratio should be lower than 15 in any stock that you analyze, and intrinsic value should be higher than the current stock price. Now, P/E ratio, I know that this might sound a bit complicated for you, especially if you're a beginner. P/E ratio tells you how much money should you spend to get €1 or $1 of earnings, okay? In our case, for Citigroup, we should spend around $20 to get $1 of earnings. You know what I mean? And P/E ratio is used to compare the stock with competition and with the overall market, okay? In our case, we would compare Citigroup with Bank of America, with Wells Fargo, with, I don't know, Bank of California, with JP Morgan, and so on and so on. And also we would compare P2 ratio with P2 ratio of the banking industry. Okay, that's how we know that it's undervalued. Now take a look at here. P2 ratio should be lower than 15, but in our case it's around 20, which is slightly higher than 15. So in terms of P2 ratio, the stock is overvalued. Now we come to the intrinsic value, and intrinsic value basically tells us the price that the company should have at this exact moment. It's that simple, okay? Let's take a look at the example right now here. So intrinsic value of Citigroup is around $100, okay? What does that mean? That means that based on some calculations, the intrinsic value should be, the current stock price should be $100, okay? But the actual stock price is $64, which is around $35 or $36, whatever, less than it should have been. You know what I mean? So intrinsic value tells you the stock price that it should have right now, and the price tells you the current stock price. It's that simple, okay? And as you see right now here, the rule tells us intrinsic value should be higher than the current price. Is that the case here? Yes, it is, because intrinsic value is by around $40 higher than it should have been, okay? It's higher than the current stock price. Sorry, bro. So yeah, in terms of the intrinsic value, it is undervalued, okay? Now you might ask yourself, okay, where do I find this data? You find P2 ratio and intrinsic value on the internet. You just write Citigroup P2 ratio or Citigroup intrinsic value and you find the numbers. Now we have one time undervalued and one time overvalued. What is now the summary of valuation? We want to be as harsh as possible whenever we analyze the stocks. So this time it's overvalued as well, even though we have one buy, kinda, and one sell, okay? So this stock is overvalued. Now we come to the price, and the instruction tells us price has to be lower than 150 euros. For me, I'm from Europe, but you are probably from America, so for you it's below $150. Now the price at the time of recording this video was $64, which is almost 2 times lower than 150. So that's a good thing. Price is underpriced. As the stock is underpriced. This is what I wanted to say. Now $150 is kind of the border between overpriced and underpriced stock. This is kind of the limit that I set for myself, because obviously whenever we invest in stocks, we don't want to spend the whole budget that we have on one single stock that costs 400 euros, and then if it crashes, we lose all 400 euros, okay? Especially when you're a beginner, you have a bit tight budget, especially if you're a young man as well, like I am and you are. So we have tight budgets, so we want to invest in stocks that are below 150, so that whenever we have a budget of let's say 500 euros, we can buy at least 4 different stocks that might perform better. Obviously we want to spread the eggs a bit, you know what I mean? Just like when you have women, you have a couple of them, okay? Nah, a bit of a joke, but you know what I mean, okay? We don't want to invest in expensive stocks. Now we come to the final evaluation, where we are just going to summarize everything that we found out about this stock so far, okay? Now, does the chart grow? No, it doesn't, because you can see that it was kind of stable through the years. It's normal chart for a bank, but still it doesn't grow, so here is a no-go, okay? Does the profit grow? No, it doesn't. They had a loss in 2017, I believe, so that's immediately a no-go for us, okay? Does the debt decrease through the years? Yes or no? No, it doesn't. Do they have positive money on the bank account? Do they have positive balance? No, they don't. They have minus $12 billion, I believe, so that's a no-go as well. Is the stock undervalued? No, it's not. Okay, with intrinsic value it is, but generally it isn't. And is the price below $150? Yes, it is. It's around 60. So what is the summary? In my opinion, I think that you should sell this stock, obviously. The biggest flag was that they had loss in 2017, okay? So for me, whenever I analyze my stocks, I am as harsh as I can be, and whenever I see a loss in profit, that's immediately a no-go for me. No matter what, how good the stock is, no matter if this is some fucking Amazon or if this is some amazing company that has $1 billion profit this year, still, if they have a loss, for me, that's a no-go. I want to be strict here. Nothing personal, it's just business, it's my money, and if you are incompetent to make loss, then you will not get my money. It's that simple, okay? Obviously, this is a big bank, they will not go bust, but still, I don't want to risk it, okay? Additionally, they don't have money on the bank account, they are literally broke, so for me, no. They are overpriced, the chart is horrible, which is expected for a bank, and just no, just like they have a loss, this is end of discussion. It's that simple, bro, okay? Now, if you want to know more about stock market evaluation, click the first link in the description and I will be honored to teach you everything about it. Click subscribe, join me on this journey to become rich with stock market investing. Do the hard work and see you on top of the world. Now let's go to the Spanish playa. Now take care, bro. Have a nice day and we'll see each other tomorrow with a new stock market analysis.